Hello everyone, I hope everyone is doing good. Here is Zubair Slim from SCAN School of Accountancy, currently teaching SPR and financial reporting in ACCA stream. Guys, in this video, I'm going to talk about IAS 1 Journal Presentation and Disclosure Exposure Draft. What is exposure draft, guys? Obviously, the board, the standard developers are proposing some changes in IAS 1. Yes, guys, you are listening it correctly. The board is proposing some changes in the financial statements, in the presentation of financial statements, and more specifically, they want changes in statement of P&L. So this topic is really important topic for SPR candidates sitting in the upcoming attempts, and it is relevant for September 2021 attempt to 30th June 2022 attempts. And obviously, if you're working in the industry, it would help you to understand what are the upcoming changes in IAS 1 as well. So let's talk about what are the major changes, what are the major proposals. So we can categorize the proposals or the upcoming changes into three categories. The first thing that the board is proposing to change is the format of your statement of P&L, guys. The first thing is they want some changes in the format of statement of P&L. We know what is the current format by function. This is sales. We need to deduct some cost of sales. Then we had GP. Then we need to deduct admin and distribution expenses. We need to add other incomes, and then we need to deduct finance cost, and then we will have profit before tax. Now, after that, we are going to deduct tax, and we'll get profit after tax. This is the format right now, guys. Most interestingly, we don't have a heading operating profit as a requirement of IAS 1. Although some companies do report operating profits, or we can say profit before interest and tax in their financial statements, but actually this is not required by current IAS 1. This is not the requirement of IAS 1. But yes, you can present some extra headings, some extra line items as per standards because these were the minimum requirements of IAS 1. So many companies do report operating profits. So guys, what are the changes? We need to talk about these changes in detail. Then we have second and third category, and I'm not going to talk about the second and third category in this video, guys, to keep this video short. So let's talk about, guys, what is first thing that we need to understand regarding the P&L change. Guys, there are certain issues. What are these issues? Listen carefully. Guys, our objective of financial statements is to provide information to investors, lenders, and creditors to help them in their decision making. This is the primary reason why we are producing financial statements. So, guys, remember the financial statements must be capable enough to help investors in their decision making. So if the financial statements are not capable to give appropriate relevant information which can help investor in their decision making, then it means the objective of financial statements are not being met, and we are failed as an accountant. So if you remember this point as a context, then you would be able to understand the issues of the investors. So listen carefully right now. The issues are that operating profit is calculated inconsistently within an industry and within different industries as well. This operating profit is a very useful profit figure which investors use as a starting point for forecasting future cash flows. And this is really an important profit measure to calculate the margins, to assess the margins of the company as well. So it means operating profit is a very important measure for the investors to take their decisions. And we all know that operating profit is calculated in a different way, inconsistently, so that investors have some issues. They are unable to compare operating profits of one company with another company. As we know that investors need to compare operating profits and the financial performance and position of different companies so that investor could make a right investment in the right company. So they need to compare different companies profits, they need to compare different companies financial performance to find the right company. So this inconsistency, this diversity in calculating operating profits, making it difficult for the investors to compare companies financial performance. So it means they are unable to take appropriate decisions. So they, if they are unable to make proper decisions, it means as an accountant we are failed to produce them a relevant information. So it means we are not fulfilling our objective. So let me give you some examples that how operating profit is being calculated inconsistently. The first example is we have profit or loss from associates and joint ventures. This is an equity accounted companies, associate and both the joint ventures. And in industry, practically, the profit or loss from associates and joint ventures are being reported in a different way. Some companies do include this profit or loss from associate and joint ventures in operating profits. Some companies are not including this in operating profits, and some companies are unclear whether to include this in operating profits or not. In the same way, there is again an issue with interest cost on defined benefit pension liabilities. We know we call it unwinding of interest as well. So some companies are treating this unwinding in the operating profit calculations, and some companies are not using this unwinding in operating profits. So look, I've just taken examples of two items. So industry companies, some companies are including these items in operating profits, some are not including these operating profits. So it means if the rules and the principles are being applied in a different way from company to company, so the investors are unable to take their appropriate decisions. So this is the problem, guys. Now we need to understand what investors say, what investors want, and the board is trying to resolve the investors issues, and the board, the standard developers, wants to give the investors what they actually need. So listen carefully, what is actually investors asking for, what the are the issues of investors, and how the board is trying to resolve the issues of the investors. So investors want some subtotals in the statement of P&L need to be comparable with between different companies. So they are asking that we need subtotals, means operating profits, or some other subtotals, means gross profits, means profit before interest and tax. They just want some subtotals in P&L that need to be comparable between different companies. So how the board is trying to resolve the issue, how the board is actually trying to amend IAS 1 to make financial statements more comparable. So listen carefully. This is the first change. So board is asking to change IS1 in such a way that they want companies to present additional defined subtotals in the statement of P&L. So listen carefully. The word defined is very important here, guys. So standard developers want to define the subtotals. They want that every subtotal should be defined. If it would be defined as per standard, then obviously everyone will follow the standard, will follow that definition, and the companies, if following the same rules, then obviously their financials will become comparable. So this was the issue, and the board is proposing how we can resolve this issue. So now guys, the second and third point is actually belongs to the second and third proposal that we are going to cover in the next videos. Now let's move towards, guys, what is the board's objective. So I hope we would be able to understand what is the objective now. They just want to improve how the information is communicated in the financial statements, with the focus on information about performance in statement of P&L. So we know that we are talking about the changes in P&L, and they just want to focus on information about the performance. So they just want to show the performance of a company in a better way to the investors. And they just want to resolve all the issues of investors they are facing right now. So let's talk about, guys, now the proposed income statement format. So this is really an interesting thing, that how the new format of statement of P&L will look like. So here is the summary from the exposure draft. So let's talk about it, guys. They just want to categorize all the items till profit before tax, into four categories. So they are proposing that we should include first activities, which is operating activities. We are well aware of this activity from the statement of cash flows. Then the second category, obviously, they wanted an investing activity, and the third category is a financing activity. So we are well aware of these three categories, guys. So they just want that on the face of statement of comprehensive income, means statement of P&L, the information should be presented in these three activities, along with integral associates and joint ventures. So this is really an interesting that they just want to present, to classify all the items of income and expenses into four categories till profit before tax. And obviously after profit before tax, we have profit after tax, and there could be a discontinued operation as well. And after that we have other comprehensive income. So the main changes are in P&L till profit before tax. Now let's talk about how the format would look like. We would have revenue, then we will have operating expenses, all the operating expenses. Then we will have profit, operating profit and loss. So this is the first heading that is required in the exposure draft, that we should have an operating profit or loss, because we know investors use this as a starting point. Investors use this to assess the margins of different companies. So the board is proposing to have an operating profit loss subtotal in the financials. Now you must be wondering why there is not gross profit heading, why there is not a revenue less cost of sale headings. Okay, these are the minimum requirements of standards, guys. If you want to add cost of sale, if the company thinks that it will be a relevant information to present information in the headings like cost of sale or the admin or distribution expense, say yes, the company can do that. If they are presenting financials according to the function of expense, then yes, they can do that. But actually, what you need to understand that you need to include revenues and the operating expenses so that you can have operating profit and loss. Then, guys, the second category is integral associates and joint ventures. So let me define what is integral associates and joint ventures. So the company need to understand that they need to divide these associates and joint ventures into two categories, guys. The first category is integral associates or joint ventures. The other category is obviously non-integral. Now, what is non-integral associates and joint ventures and what is integral associates and joint ventures? Now we need to understand this point. So what is integral, guys? This is something important. So integral associates or joint ventures are those associates and joint ventures whose activities are closely related to the company's main business activities. What does it mean? If there is an associate and joint ventures and they are in similar nature of business, like their investors, then they are closely related associates and closely related joint ventures because the activities of both the investor and the associate and joint ventures are closely related. We will say that these are integral associates and joint ventures. So, look, we are going to assess the company's performance through P&L. If the associate and joint venture is integral, means their activities are very close to the business main activities, then it means it should also be reflected along with operating profits. It should be a part of, it should be reflected very close to operating profits so that investor can understand that these are the associates which are very closely related to the business activities, and we should assess these associates and joint ventures as well in order to understand the performance of the company. And what is non-integral associates and joint ventures? Obviously, the associates and joint ventures which have activities which are not closely related to the main business activities. If it means if there's a bank as an investor, there's a bank company which obviously we all know what is the activities of bank. They just want to earn the interest. Their main ordinary business is to earn interest. If they have investment in associate in a textile company, then obviously their activities are not closely related. So we will say that these are the non-integral associates or joint ventures. Okay. So the second category is integral associates and joint ventures, and you need to present the share of profit or loss of integral associates and joint ventures close to the operating profit, right behind the operating profit or loss, because these are closely related. Okay, so it should be close to the operating profit. So this is the second category, guys. Then after this, we will have now operating profit was there. In operating profit, we have added profit or loss from integral associates and joint ventures. Now we have operating profit or loss and income and expenses from integral associate and joint ventures. So the heading, the second subtotal is operating profit plus income or expenses from integral associates and joint ventures. Then, guys, we have another activity which is investing activities. You need to understand what is investing activities very carefully, guys. Very carefully. What is investing activities? Listen carefully. Guys, in investing activities, the first thing would be non-integral associates and joint ventures. It means non-integral associates and joint ventures profit loss share would be reflected in investing activities, and the integral associates and joint ventures profit loss will be very close to operating profit. Okay, now what's next, sir? The next thing would be, this is important, guys, only those investments which can generate cash flows independently from other assets of the business, which can generate cash flows standalone. They can generate cash flows, they can generate returns on their own. They don't need other assets of the business. They are independent investments, guys. So the word independent is very important here in investing activities, guys. Very important. Independent investments. So let me give you few examples. The first independent example is financial assets. If we have investment in equity, if we have investment in debt, these are the independent assets. These assets don't need any other asset of the business to generate cash flows. If I have bought some shares from the stock exchange, they can independently generate cash flows for me, for my company. So this is investing cash inflow, guys, or obviously the outflow or the loss or profit. Okay. Then the another example is, the best example is, another best example is obviously investment property. Guys, we all know that investment property is a property that can generate cash flows independently from other assets of the business. So this, the standalone feature of this property is that it can only and only generate cash flows independently. These investment property don't need other assets of the business. So if this investment property can generate cash flows independently, then it means any gain or loss, very important. We all know that we have fair value through P&L investments, we have fair value through OC investments, then we have profit or loss on derecognition of these investments. So any fair value movements, any dividend income, any fair value movement, any dividend income, any gain, any loss, any profit or loss on derecognition of financial assets as well as investment property will be reflected under investing activities. Now you must be thinking that what about property, plant and equipment, sir? What about property, plant and equipment? Guys, in property, plant and equipment cannot generate cash flows independently, guys. Inventory cannot generate cash flows independently. So it means they cannot generate cash flows independently. It means property, plant and equipment, profit or loss of property, plant and equipment on disposal of property, plant and equipment. In the same way, inventory, NRV adjustments, profit or loss on sale of inventory. These items will generate some profit, some loss, some income. This will not be reflected under the investing category because the most important word is independent. Here, independently, these assets are not independently generating cash flows. So the property, plant and equipment would not come here. So then, sir, where can we classify the profit or loss on disposal of property, plant and equipment, the depreciation expense of property, plant and equipment? So any related income or expense, impairment loss of property, plant and equipment, where we can classify it. So it cannot be classified under investing activity. Obviously, it cannot be classified under financing activity as well. And obviously, if it cannot be classified under investing and financing, as well as if this is not an associate and joint venture, then obviously we have only one category left, which is operating profits, guys. It means, as per the revised IAS 1, the proposal, this is the default category. If you have some income or expense and you are unable to classify this in part item in investing activity, in financing, in integral associates or joint ventures, then obviously you are going to show it in the operating activities. So this is something important. How they define the operating items, this is actually a default category. You can say the residual category. If you are unable to classify an item in investing and financing, then you will classify it in operating. Okay, fine. Now, sir, what is the next heading? So the first heading is, guys, operating profit loss. The second heading is operating profit plus expenses from integral associates. Then we have investing as well. Now we have profit or loss before financing and income tax, because the financing category is still there and then income tax is still there. So what is financing activities? We all know that financing activity actually is actually all the cash flows related to the debt, all the income and expenses related to the debt instruments. So if you have debt in issue, obviously the interest expense of that debt instrument, profit or loss on the derecognition of that debt instrument will be in financing activities. Then we have pension liabilities and provisions as well. We need to unwind the provisions if we have recognized the provision at present value, and we need to unwind the pension liability as well. So the unwinding on all the liabilities will also be reflected under the financing activities. And obviously, if we have some expenses related to financing activities, that will also be shown under the financing category. Now, what is the most important area here is that if you are generating some interest revenue on cash and cash equivalent, if you have some surplus cash in your bank account, in your saving accounts, and you are generating some interest on that cash equivalent on your cash deposit accounts, that interest income or that interest expense, so obviously if you have bank overdrawn, you have to pay the interest, that will come under the heading of financing activity. So this is something important, that if you are generating interest income from your normal cash or cash equivalent balances, then you cannot classify this interest revenue in investing. It will be a part of financing. So this is something important. But now you need to be careful here. If we are dealing with the banks whose main ordinary business is to generate interest from the cash and cash equivalents, then obviously from the financing activities, then obviously these interest income and expenses would be a part of operating activities in case of banks, because their main ordinary business is to generate interest income from the ordinary course of business by lending the money. Then obviously these cash flows in case of banks will be under the operating categories. So guys, these are the four categories that you need to show on the face of statement of P&L as per the proposed standard. This is proposed standard. This is not actual part. If we have a simple question, then obviously we'll talk about the formats that we are currently following. We'll not talk about these changes. If the examiner is specifically asking about the proposed changes, the exposure draft, the upcoming changes, then we will talk about these areas. So guys, there are four new categories. This was the most important points. They have defined these four defined new categories. They have three subtotals. Then obviously before profit before tax, then we have tax, profit after tax. Those subtotals are actually the totals that we are currently using, but they have added three new totals here, guys. And this is the way they just want to propose the income statement. All these things are written here, guys. I have already explained these things, and here is the non-integral associates and the integral associates definition as well. You can easily read these things from these slides. And thank you so much, guys. And see you soon in the next video where we'll be covering the other two proposals as well. Thank you so much, guys. Stay blessed.